The concepts of indirect and direct taxation are really not technical or legal things. It's basically a categorization of things that are associated or attached with wealth and income. We call those direct taxes, which includes income tax, rates, stamp duty, land tax, and payroll tax. They're direct taxes, and you can sort of fold company tax and capital gains tax into this system of direct taxation in Australia because we basically fold those into the income tax system. When we refer to indirect taxes, really what we're referring to is everything else. So all other ways that the government levies some form of excise or tax on individuals or entities. So for the purposes of our subject, this is the goods and services tax or GST, the fringe benefit tax or FBT, as well as excise and customs duty. The goods and services tax or GST is a form of indirect taxation. It's also known as a regressive tax. What we mean by that is that it disproportionately impacts those who are poor, both in terms of net wealth and in terms of income. It affects them more than it does people who are conversely wealthy. So as a result, the GST was quite a difficult system politically to bring about in the mid to late 1990s. As part of bringing the GST into being, the government of the day, which was the Howard government, made large numbers of concessions. And so as a result, the GST system, which on the face of it seems quite simple, has many exceptions to the rules. And most of these have come about in order to get the legislation passed through the Senate. Now, after the legislation was passed, there were, as there often are for taxation or new taxation acts that come in, some challenges, and these went to the High Court. And the High Court pretty commonsensically dismissed these applications, basically to say that the legislation, the way that it was structured, was lawful. It did only deal with one subject of taxation and did not discriminate between the states. And the other key thing to note is that the GST itself, again, as part of the political need to get the thing passed, all of the revenue is redistributed to the states using a slightly arcane formula that some states that contribute more to it from time to time can sort of complain about. One thing to note about the operation of the GST in Australia is that in other jurisdictions, this form of taxation is known as a consumption tax. And that's not strictly legally correct. In Australia, the relevant event in which tax arises is the supply of goods and services. Note that the GST that is payable on a taxable supply is 1/11th of the price of the item. So, for example, if you sell an item and you receive $1,100, you are obliged to remit $100 to the ATO. One of the very important features of the Australian GST system is the way credits work. Using my previous example, if I supplied goods and I received $1,100, I would be obliged to remit $100 of that to the Commissioner. Okay. Now, if, however, I had purchased things and paid money for those things that went into the supply that I've just made and then received $1,100 for, those supplies, a fraction of that amount, I'm going to be paying GST on. And so that the person who I purchased those things from is going to have to remit that amount of money to the Commissioner. Ultimately, though, if I pay some amount of GST when purchasing goods, then sell those goods for more, it's actually only the difference between the amount of GST that I pay on supplies, which here we call input tax credits, and the amount of GST that I receive. That's the GST charged by me. It's only the difference between those two things that you have to pay at the end of each GST period. Note that in situations where the amount of input tax credits you've earned is more than the amount of GST charged, in other words, you've spent more money and functionally paid more GST as part of acquiring those goods, then you've gathered through selling stuff. So if you basically spent more than you've earned, you actually get the difference refunded to you as part of that. Look, there's another point I just want to make here to clarify this. Unfortunately, we use the word input tax a few times in the GST rules. And when we're referring to input tax credits. That is to do with what we call creditable acquisitions. That is essentially the GST that we've paid when we're purchasing goods and services in order to supply them elsewhere. We call the amount of GST that we pay input tax credit. That's actually slightly different later on from a term when we refer to input taxed supplies. That actually functionally means something quite different. And it's something that can be very confusing to people when they're trying to learn and understand the GST system. So just make note that later in this recording, I'll talk about input taxed supplies. That is functionally completely different to input tax credits. It's a really important point to note, otherwise you can end up quite confused. In order for GST to arise on a particular supply, a series of elements have got to be met as part of that. And some of these are going to seem pretty straightforward. So obviously the first element is that there is actually a supply of goods and services. The second thing is that the supply has to be made for consideration. Now, this, ultimately is a question of evidence based on the circumstances, but the key thing to note is that a pure gift will not be deemed to be a supply as part of that. And similarly, for those students who may recall both from their business and law degrees, the idea of some forms of consideration, illusory consideration and past consideration not being valid. However, merely reducing the amount payable to zero won't stop this element being satisfied. The third element is that a particular supply has to be made in the course or furtherance of an enterprise. And this is expressed far more broadly than merely a business. Also, a particular supply has to be connected with Australia, or technically the Australian taxation area, which includes a variety of offshore places also. Also, there are two particular words or phrases that we use to describe types of supplies that don't have GST, and we call those either GST-free or input taxed. Kind of unfortunate, this definition of the word input taxed is used twice in two quite different ways. And so each of these elements has to be satisfied in order for GST to become liable for a particular supply. So starting by looking a little bit more depth into the words that make up the elements of a taxable supply. Starting with the word supply, it's got a very broad definition. One of the themes that you'll see in pretty much all of the indirect taxation is that there are no easy loopholes in these. The definition, both in terms of how it's mapped out in the relevant legislation and also how the courts have interpreted this legislation, deliberately take a broad stance. Now, there are, however, some things that the legislation specifically excludes, and the courts have analysed over time to find in certain circumstances either will or won't count as being a supply. The key thing to note, the money, the loaning or payment of money is not going to be a supply within the meaning of the GST legislation. However, I will note that in the Travelex case, about 10 years ago in the High Court, they did note that in a situation where banknotes themselves were the things that were being supplied, in this case, the little kiosks that you have at airports, in those situations, the money that's supplied there will be deemed to be a taxable supply. Another relatively recent change is that digital currencies, cryptocurrencies, are no longer subject to any form of GST. One important area to note, and again a relatively recent case, is where there's prepayment of goods and services. So the example here was Qantas, who went to the High Court and unsuccessfully tried to argue that where customers purchase airline tickets and then for whatever reason don't turn up, Qantas tried to argue that that wasn't a supply. However, the High Court disagreed. So in a situation where there is some form of prepayment of goods and services, then that will still be a supply within the meaning of the GST regime. In some situations, there is going to be a supply of goods and services that's really a combination of goods and services. In other words, you're going to have some particular parts of the goods or services that are going to be taxable, and some that may have some form of different GST treatment. Either they might be input taxed or GST free. Where you have one of these supplies where they're mixed up, the courts by default will look at the main component and really look at the dominant purpose of the particular goods or supplies in order to determine whether or not that's going to be considered to be all one item or one service for the purposes of GST. Now, that rule is going to apply where it's going to look at the main purpose or the dominant purpose of a particular supply, and in that situation the entire supply is going to take on that characteristic. But really that applies where you can't easily separate the things out, or where a particular component of the supply is merely incidental. It's only a small amount, or it's ancillary to the main purpose. So, for example, the supply of some form of professional services, and then the physical paper, for example, that something is written on, that's really ancillary to the underlying purpose of that particular supply. However, where you can differentiate things and separate them out, each of those separate items will be calculated separately. So the idea is that where you've got one of these mixed supplies and you've got lots of different components that can be readily identified, if they have different tax treatment, they will receive different tax treatment as part of the process. Where we look at consideration as an element of a taxable supply for GST purposes, you'll also see this common theme of the particular word having a very broad definition. And also note that where a supply has been made to an associate with either some reduced or inadequate consideration or simply no consideration at all, then for the purposes of the GST law, they actually apply Section 318 of the Old Income Tax Act. It has a very, very broad definition of associate that is going to include both business associates, so partners in the same firm or related companies, but also familial relationships as well, so your life partners and family members. And in those situations where supply is made for an inadequate amount of consideration, the amount of tax that's going to apply is going to be the amount that would have applied if the market value was used instead. So it's essentially a market substitution rule for the purposes of GST. When we look at the statutory definition of a particular supply being made within the course of an enterprise, this is much broader than merely business and business-to-business transactions. So while it doesn't include businesses. It's also going to include transactions between joint ventures, joint venturees. It's going to include leases, licenses, and grants in real property. It's going to include transactions that are made by trustees of superannuation funds, although it doesn't strictly include trustees of other types of trusts. It includes supplies made in the course of running charities, and it includes transactions that are entered into by the Commonwealth, by any of the states, and by any public authority created under statute by either of those. While certain types of activities are excluded implicitly in the definition of an enterprise, there are also some explicit exclusions in the legislation as well. And the key one here is employees. Employee is never carrying on an enterprise for the purposes of the GST regime. It also expressly maps out that supplies made that are to do with hobbies or private recreational pursuits, and individuals and partnerships undertaking, basically undertaking things that might have been an enterprise but without any form of reasonable expectation of profit or gain, are going to be excluded under the statutory rules. Now, continuing this theme of broad definitions, the connection to Australia element also is expressed very, very widely. And so clearly goods are going to be connected with Australia if they're physically in Australia, if they've been delivered physically in Australia. But it's also going to include suppliers carrying on an enterprise within Australia. It's going to apply clearly to any form of Australian real property, as well as rights or options involving things that are connected to Australia as well. And finally, it's going to be connected with Australia if ultimately the supply goes to an Australian consumer. So technically GST is only charged and made payable by GST registered entities. However, if an entity is required to be registered, GST will also become payable as well. And so where you've got a turnover of more than $75,000 per annum, you have to register for GST. And obviously, if you don't register, if you're under that threshold, you can't claim input tax credits on amounts that you expend. Now, in terms of reporting, the entities must complete the GST information in their base returns. That's the business activity statements. These are documents that are required as part of running a business in Australia that have to be submitted on a regular basis. Now, the size of the entity determines how regular that is. And note also that some types of industries, taxis for example, must be registered for GST regardless of the size of their turnover. Turning now to the method in which a particular taxpayer accounts for GST. These rules kind of mirror the income tax rules in that small entities can use a cash basis for accounting for income tax, but also for GST as well. In situations where a smaller taxpayer uses a cash basis, GST becomes payable when the amount is received. Now, this is not the case for accruals-based taxpayers. In that situation, it is the earlier of when the amount is received, or the consideration is received, and when the invoice is issued. So how does one get to choose their accounting basis? All of these things are to do with size. So that if a particular entity is a small business entity within the meaning of the income tax rules, in that situation, you are allowed to use the cash accounting basis for GST. You can also use it if you are a charity or some other entity that doesn't carry on a business, strictly speaking. So an entity that falls within the definition of an enterprise, but it isn't a business. You can use the cash basis there, provided your turnover is less than $2 million. You can also ask the Commissioner. So the ATO has rules that allow people to apply. Usually you've got to supply some form of reason. And note ultimately that while it is a reviewable decision, it's still ultimately the discretion of the Commissioner. Turning now to supplies that don't have GST. And these come in two types. The first, and I think tongue-in-cheek, I sort of refer to as the good type, are supplies that are referred to as being GST-free. Those sorts of goods or services are ones in which you don't have to pay GST for goods and services that you supply, but you can claim input tax credits for amounts that you expend in regards to generating those particular supplies. That's the good type. The not quite so good type are known as input tax, and very unfortunately it uses the same phrase as input tax credits. They are quite different things. When you hear the phrase a supply being input taxed, that means that you both don't collect GST and pay it to the Commissioner, but you also can't claim GST on goods or services that you purchase trying to create or undertake that particular supply. These amounts that the taxpayer pays towards purchasing inputs, so goods that are then on-sold or used in the process of manufacturing, are known as creditable acquisitions within the GST legislation. And the idea being that the amount that you spend on these creditable acquisitions, 1/11 of that is going to be the input tax credit that you can then use to offset liability that you will incur when you charge GST and obtain that from your customers when you supply goods and services. Note that the difference between the amount you take in and the amount of credits that you receive from amounts that you've paid is going to be the amount which is either payable or possibly refundable in a particular GST period. Thus, functionally, the input tax credit system in the Australian GST regime is neutral. Where you've got one business selling something to another business, one side must collect GST and the other side is entitled to a credit of GST for the exact same amount. Thus, where there is a chain of events of goods being sold within Australia, these in-between transactions are ultimately going to be completely neutral from the Commissioner's perspective in terms of the amount of GST that's paid. So the other thing to note here is that it's the amount of input tax credit that one has to pay is the same as the amount that the entity has to charge. It's 1/11. So if you purchase something for $110, that's the purchase price, the cash amount that you have to pay, $100 of that will be an input tax credit. Now, like many rules that may seem so obvious that they go without saying, because this is tax law, needs to be said, and that's that if you acquire goods only partly for a creditable purpose, or if you only pay for a fraction of the consideration for those particular goods, guess what? You can only claim that portion as part of that. And if it can't be ascertained, it's a reasonable portion of that particular acquisition. So you're only going to be able to claim a reasonable portion for a creditable acquisition if you can't determine the fraction that's going to be non-creditable. One of the key differences between GST taxation and other forms is that the real world gets in the way a lot more for the supplies of goods and services than in other areas of taxation, land and employment related issues. What do I mean by that? What I mean is that it is quite common for goods and services to change from being a taxable supply or non-taxable supply, or if consideration for a particular supplier acquisition is somehow altered or extinguished, And as such, the system of making adjustments in regards to the returns that a particular taxpayer has made are far more common in the GST system than they are in other areas of taxation. So it's important to note that this happens frequently, and these changes are known as adjustment events. And so ultimately, an adjustment event is either going to increase or decrease the amount of GST which is payable, or the amount of refund that a taxpayer may have for a particular period. So how does one pay GST? Well, anyone in business will be familiar with the concept of the BAS return. Now, the business activity statement, it's a formal document that a taxpayer is required to fill in and complete for a variety of regulatory mechanisms. Now, for GST, again, the size of the entity determines how often you have to fill these things in. Note that for most entities, it's quarterly. So you do 4 each year, with the 30th of June being one of those 4 reporting periods, the end of March, end of September, end of December. Where you've got a small entity, so one which is less than $75,000, those usually are not required to be registered for GST, so that if you have elected to be registered and you are, as a result, are both claiming input tax credits and are required to pay GST as part of that, then you can file annually. Very large entities, or medium to large entities, with a turnover of more than $10 million each year are required to file BAS returns monthly. And when you file your BAS return, you will calculate the amount of GST which is either payable or refundable for that particular period, and either have to pay that or have it credited back to you. Turning now to the exceptions, and there are lots of exemptions for GST. And so this particular piece of tax legislation was quite difficult to push through, particularly the Australian Senate. And so as a result, there were lots of concessions that were made, and these have persisted throughout the legislation over the last 20 odd years. So when you're looking at these categories of GST-free supplies, note that most of them have been done for sometimes cynical political reasons, some for very deliberate policy choices, and there is a lot of sort of social welfare and benefit to society as part of the reason for electing certain types of goods and services to be GST-free. Also note that GST-free is the good type of GST-free acquisitions, because these are the ones where you get to still claim the input tax credits on, and that is different from what we call input taxed supplies, which you can't. So starting with the first, most obvious, most politically difficult area, which is GST on food. And the starting point is there is no GST on food. So food, for the purposes of the GST system, includes food, as we would ordinarily think of it, excluding alcohol in that definition, and things that go into the making of food. So that's ingredients as well as flavorings and spices and such like. So the starting point there is that food doesn't have GST. The exception to the exception are foods that are deemed by the powers that be to be unhealthy. And these include confectionery, savoury snacks, bakery foods, ice creams and biscuits and such like. So that those aren't considered to be food within the purpose of the GST regime, and thus GST does apply to those particular classifications of items. Also note that while there are these collection of legislated items, the relevant minister can actually also create delegated rules, so regulations, which exclude items from the GST status without having to call Parliament. So that can be just merely done through systems of regulation. There is another important area of goods and services, and those are things to do with health. So the starting point is that health services provided by medical practices are going to be GST free. Also note that allied health professional services are going to be GST free as well. And the statutory definition for these health services is quite extensive. So it covers the obvious ones: psychology, nursing, speech pathology, physiotherapy and such like. But it also includes things like social work and a variety of alternative medical practitioners as well. So that definition is expressed very, very broadly. Also note that where goods are supplied as part of those services. So, for example, if you've gone to a doctor and they've put a bandage on, though that's technically goods that are supplied in the process of supplying services, they're also going to be GST free as well. Note that there are certain types of elective procedures that are not GST free, with the most obvious here being cosmetic surgery. You do have to pay GST on those types of medical procedures. You also have to pay GST on pharmaceutical products that are sold over the counter. So, for example, if you were to go into Coles and buy bandages, or you were to go to the pharmacy and purchase things that you are acquiring without a prescription, those will have GST attached or associated with them. A couple of other things that are GST free: private health insurance and things that relate to residential care and retirement villages. Those areas under the legislation are going to be GST free. And now for the question that budding tax law students, well, probably not really that concerned about, but as a piece of information, education services are GST free. So the cost of undertaking education in tertiary institutions, you don't have to pay GST on. Now, you do have to pay GST on textbooks, computers, and such things that you use as part of undertaking your studies, but you don't have to pay GST on things that are prescribed or necessary in a particular course. So that if you have, for example, lab classes that you would undertake as part of your studies, that the materials that are used up or consumed as part of that are going to be GST free, provided that they are prescribed and supplied to you as part of this process. One of the really lovely things about being an exporter is that every month or every quarter, when you do your BAS return, the government's going to give you money. Why? Because there's no GST on exports. So if you're going to be supplying goods that are going to be exported, again, within 60 days of either you issuing an invoice or receiving payment, then that particular supply of goods is going to be GST free. And so that, in many ways, is an advantage from a cash flow perspective for businesses that do a lot of exporting. Another area of exemption from GST is where a business is sold as a going concern. Now, there's a few little rules here. I mean, basically, both buyer and seller have to be GST registered, and they have to map it out in the agreement. They have to basically just overtly and expressly state that the business is to be sold as a going concern as part of that process. With charities, if they undertake some form of commercial activity, then those activities are going to attract GST normally. However, the non-commercial activities of charities will not. So if goods and services are supplied by charities, that is going to be GST free. There are a few other particular areas where GST is exempted. It's probably worth noting these. First is where us as individuals sell our stuff. So the sale of second-hand goods outside the scope of a business. So if you're not a registered second-hand goods dealer, or you're not supplying the goods as part of a business which is unrelated to that, that's not going to have GST as part of it. Also note that these days, and a relatively recent change, that where you purchase goods from offshore vendors, that is going to be subject to GST. So up until relatively recently, if you purchase goods offshore, they wouldn't be subject to GST, and a few well-known local retailers basically lobbied the government to make that change. And so now if you purchase goods from offshore, if you purchase through one of the mainstream vendors, Amazon or the equivalent, they will actually add GST on directly, and they will remit that to the federal government. If you're purchasing it from something outside the scope of those vendors, you'll be required to pay the GST by customs. Also note that a variety of other forms of taxation are not subject to GST: rates, stamp duty, land tax. I'll turn now to talking about input taxed items. Now, input taxed is similar in operation to GST-free items, but the one very important difference is that where you make an input tax supply, you cannot claim input tax credits for items that have been acquired in regards to that particular supply, be they goods or services. One thing to note, that if you're not too sure about these things, and again, there are systems of rulings in regards to GST transactions, but by and large, if a particular supply could be deemed as either input taxed or GST free, it's usually going to be deemed GST free. What that means is that you will be able to claim input tax credits for things that went into the production of that particular goods or service that's supplied. The GST regime has 5 categories of these input tax supplies. These are supplies that you can't get input tax credits in relation to. First is financial supplies. The second is the sale or the lease thereof of residential premises. The third is the supply of precious metals. And the fourth is a little bit of an unusual one. It's a very, very narrow set of circumstances to do with school tuck shops and canteens. And the fifth are fundraising activities undertaken by charities. When we're looking at financial supplies, which again are input taxed, so in other words, not subject to GST, and you can't claim input tax credits in regards those transactions, it has a very broad definition. And so financial supplies are going to include sort of credits, mortgages, any form of derivatives, guarantees, the transfer of currency. And look, this is deliberately left very, very open. So there's no real mechanism for people to create some sort of derivative on a derivative in order to bypass this. They're just going to be input taxed. But most of us with some amount of accounting background will appreciate and recognize these financial supplies as really being related to the financial system itself. You should note, as an exception to that exception, there are certain types of services that relate to financial transactions that will have GST charged them normally. And those are things that are more than merely incidental to the financing. So that professional services, for example, if you give taxation advice or accounting advice or legal advice in regards to financial transactions, that's just going to be a professional service, and that's going to have GST attached to it normally. Similarly, brokerage as part of that as well, and debt collection is that. Also, the operation of payment systems and the option to make or to receive taxable supplies. Now, this seems like it would have fallen under the main category of input tax financial supplies. But here, we're not talking about options across financial products or instruments. We're talking about options over taxable supplies themselves. In that situation, having or creating those contractual options will be an exception to the exception and are going to have GST attached to them normally. So, when the GST regime was getting pushed through, there was a variety of pressure groups that influenced the final makeup of this particular series of legislation. One of those pressure groups was the banks. So when we say that financial supplies are input taxed, in other words, you can neither charge GST or you're not obliged to charge GST and you can't claim input tax credits, that there is an exception to that. And that exception, well, forms two categories. The first one is for certain types of supplies, including transaction banking and cash management, and a variety of sort of related things, loan services, debt collection, and payment and fund transfer services. If you happen to be supplying those sorts of services, you can still claim an input tax credit, but it's reduced. You actually only claim it at a 7.5% rather than 10% of the amounts that you've spent. So it was kind of a win-win for the banks that they could still claim some fraction, but it wasn't going to be the full amount. So these things apply if you're creating these forms of supplies. You can get a reduced amount of input tax credit in regards to those businesses. Now, there is another exception to this, which is the de minimis exception. And so this applies if both the amount of input taxed items is not 10% of your both current and likely future acquisitions, and the amount is going to be less than $150,000. If both of those things are true, then you can claim input tax credits in regards to your financial supplies that normally would be input taxed and you wouldn't be able to. Residential property is also input taxed. Now, where you sell a residential or existing residential property or enter into a long-term lease, that's simply going to be input taxed without exception. If, however, there is a short-term lease of some sort of residential premises that is taking place in some form of commercial setting, and again, the examples that they have are rooming accommodation and hotels in some form of commercial setting run by commercial operators. In those situations, then that will be subject to GST and is not input taxed. Generally, though, for individuals taking out short-term leases of residential premises, they will be input taxed, and there's no GST both charged and claimable. Note, however, that where a new residential premise is being sold, or any sort of commercial property, that's just going to have GST normally. Precious metals, given their particular quality of being a hedge against inflation, here I'm thinking gold, but ultimately they're used essentially as a surrogate for currency. And as such, when you have transactions involving precious metals, they are going to be input taxed. However, there is one exception, and I guess it's kind of logical, being that Australia is a resource nation, that it's GST free when you're digging the stuff out of the ground. What does that mean? It means that the mining companies can claim all of the input tax credits in regards to the costs that they spend creating or acquiring these precious metals. So all of the expenses they incur as part of essentially digging the stuff out of the ground. However, once they've sold it, which is going to be a GST-free supply. From that point onwards, any supplies are going to be input taxed normally. GST can be quite a fiddly tax, and given that it applies to even the smallest of transactions, there is some overhead to taxpayers complying to the GST regime. In order to reduce some of these compliance costs, where you've got transactions between entities that are related to each other, because there's ultimately no difference from the commissioner's perspective, where you've got a related entity buying and selling goods or services between each other, because one is going to claim input tax credits and the other one's going to have to pay the equivalent amount. You can set up a GST group whereby the intra-group transactions are going to be essentially disregarded as part of this process. So you are reporting as one entity. Where you are importing goods, you're going to have to pay GST directly on those. And the way this works is that you will usually have to deal with customs, so the relevant government department that deals with importing, and they're actually the body that collects this the GST at this particular point. And if for certain types of imports, there's going to be customs duty as well attached with that, so that you can pay at that particular point, and you can pay when the next BAS return is due. And note that in regards to GST being payable on goods over $1,000, customs will collect those those amounts in regards to consumers. Where you've got goods that are less than $1,000, as a relatively recent change, the vendors themselves are going to have to incorporate this as part of their electronic distribution platform. Again, this is for the eBays, PayPals, and Amazons of this world. In situations where you are not dealing through an electronic distribution platform, so you're buying directly from a vendor overseas, again, customs will collect the amount which is owing under their powers. Vouchers, that is some form of prepayment for goods and services which can be exchanged with third parties or used yourself, are something of a difficult area in regards to GST. And the reason for that is that the purchase of the voucher and the supplying goods and services aren't directly related. In other words, you could supply someone with vouchers and they might use them or they might not use them. And so the way that they're handled under the Australian GST system is that the supply of a voucher will not be a taxable supply. However, that is only if the terms and conditions of that particular voucher actually state that it is for an amount up to a certain value. The voucher can't exceed that, or the goods that are supplied can't exceed that. In situations where a voucher isn't redeemed, and this can occur, for example, if a voucher has an expiry date, the relevant supplier of those goods and services has to make some form of adjustment, and they'll do that through their BAS return to make an increasing adjustment in regards to that particular return. So, what powers does the tax office have to collect GST? Very wide-reaching and powerful ones. Functionally, it's the same as the income tax regime. The commissioner is vested with very, very strong powers in order to collect and recover amounts of tax payable, and GST is no exception. Know that there's no limitation period in regards to that, unlike the limits in regards to income tax. Also note that GST can actually be claimed from directors personally in situations where a company, for example, has been liquidated or phoenixed, or some other arrangement has been made in order to try and avoid GST liability. all of the ordinary powers that a taxpayer has in regards to an assessment for income tax apply to GST. In other words, you have your assessment and you can commence challenging it by making an objection. And if you don't like the results of the objection, which is essentially asking the decision maker, the tax office, to remake their original decision, if you don't like that, you can then go to the AAT and seek a review. And if you don't like that, you can go to the federal court normally and appeal that. Note that the statutory limit for lodging an objection is 4 years after a particular assessment is made. A similar system of public and private rulings applies to the GST regime, just as it does for income tax. The idea is that you, as a taxpayer, can seek a private ruling from the Commissioner in regards to a transaction or a series of transactions. The Commissioner can also make public rulings in regards to classes of transactions or a statement of her or his understanding of the law in regards to the GST system. Note that rulings that are revised by the Commissioner are going to apply from transactions from that date afterwards. It won't apply retrospectively in regards to these revision of both public and private rulings. The Commissioner is given power to strike out transactions in situations where the taxpayer or taxpayers have entered into a series of transactions or created some form of artificial system or contrived scheme. So the Commissioner can issue a determination that precludes a particular taxpayer from obtaining some form of benefit under the GST system. All of the penalties, offences and defences to those penalties and offences for income tax apply equally to the GST system. The interest rates are the same, so for shortfall amounts, and the systems that the Commissioner can use for enforcing these is the same. Note, however, that there are some specific offences and specific penalties that relate to the GST regime, and those are involved with the registration or failure to register for GST, failure to provide GST returns, or to issue particular invoices or adjustment notes in regards to GST. Fringe benefits is a different form of indirect taxation. It's really designed to fill in the gaps where employers provide employees some form of non-cash remuneration. Before the FBT regime came in, it was quite difficult for the federal government to capture situations where employers, instead of paying more salary, would go through and give some form of remuneration, again, use of the car or some sort of discounted loans or some other system in order to remunerate them in lieu of salary. Now, under 23 capital L of the old Act, the idea is that those amounts would be determined to be income, and that, in theory, would have been added to the employee's assessable income. In practical terms, though, that was very, very hard to enforce and police. And so, as a result, in the mid-1980s, the federal government introduced a piece of legislation in order to really shift the incentives of employers away from giving these non-cash forms of remuneration to employees. And so the fringe benefit tax system really steps in to make it indistinguishable for high income earners receiving fringe benefits as opposed to salaries. really that's the ultimate goal here. So that the amount of tax that's paid for people on the top marginal rate is the same. Thus, for all employees earning less than the top marginal rate, in almost all situations, you're better off paying those employees more and having them go and obtain the particular non-cash benefit out of their post-tax income. Really, it's designed to be or to create some sort of incentive to sort of move away from giving these sorts of benefits, other than certain types of benefits that achieve some sort of social good, social end, and they fall within the categories of exemptions. We'll deal with each in turn. Now, this notion of a fringe benefit is quite central to the statutory regime for taxing. And there's a couple of other sort of key things to note here. Because fringe benefit tax is kind of technically an indirect tax, it actually doesn't align, the FBT year doesn't align with the income tax year. So the FBT year runs for, I guess, administrative reasons, from the 1st of April through to the 31st of March in the next year. And look, functionally, the purpose of fringe benefit tax and the rates of fringe benefit tax are supposed to mirror the amount of tax that an employer would otherwise need to withhold from an employee when paying them on the top marginal rate. And so the two things are very much in alignment. It can be a little bit problematic because the years don't align, and certainly I believe in 2017 there were some difficulties there where an additional levy, the budget repair levy, was put in by the Abbott government. And so by and large, those things, while the purists get a little bit upset about it, generally they have very little impact in terms of changing or modifying people's behaviour. Over the long term, though, the fringe benefit regime has very much curtailed the widespread use of fringe benefits in order to avoid income tax. A couple of other things to note: that the employer is required to remit the aggregate of the fringe benefit tax, basically the amount that they're liable for each particular year. I guess functionally, paying a fringe benefit tax as well as supplying the particular benefit is I guess functionally the same as paying salary, and that you would pay a salary amount, and that would be the amount of income the particular person receives, of which a fraction of that is going to be PAYG. So that ultimately it's the same thing. The employer is entitled to deduction for both the cost of the benefit as well as the amount of fringe benefit tax that is payable in regards to that benefit. Note that there is a situation where a tax-exempt employer can actually get a rebate in situations where they're unable to claim a tax deduction, because ultimately paying that fringe benefit would be, I guess, functionally worth less to them as a result. In terms of the employee, a fringe benefit which is received, remember that the tax has already been paid on that amount, and so thus the benefit itself is non-assessable, non-exempt income in regards to that. Also note, though, that employees still have to report those fringe benefits because even though it's non-accessible, non-exempt income, other types of tests for other government agencies will still take this into account, including the Child Support Agency, the HECS and HELP repayment system, and the concessions for spouse contributions, as well as Medicare. Much like income tax, fringe benefit tax relies on self-assessment. So taxpayers will do their own assessments, and by default, when they submit those assessments, those are what the Commissioner is going to deem to be their actual notice of assessment. Note that you don't have to pay in installments FBT unless your previous year of tax has been $3,000 or more. And when you are doing your installments about, you basically look at the previous year's FBT liability or a reasonable estimate of its current year liability in regards to doing this assessment process and then paying in installments. The Federal Commissioner of Taxation has all of her or his ordinary powers to collect fringe benefit tax and recover it. There's no limitation period on the liability of the tax office to claim outstanding FBT amounts, and they can also be claimed from directors and from the officers of the company directly in a situation where a particular company, again, has been phoenixed or has been liquidated in order to not pay these particular liabilities. In a similar vein to other areas of tax, where an assessment has been made by the Commissioner that a taxpayer is dissatisfied with, that taxpayer can lodge an objection. That's the first step of seeking to change a particular assessment in some way. It's essentially asking the decision maker, in this case the Commissioner, to remake that decision. And like other areas of tax law, if you're dissatisfied with the results of this objection, you can then seek to have that reviewed in the AAT normally and ultimately appealed, if necessary, to the federal court after that. As with GST, there's a 4-year limitation period in which you can lodge an objection for a particular assessment. Fringe benefit tax, as with all other taxes, has offences, penalties, and some defences too in terms of late payments. So the ordinary offences that would apply for income tax or for GST or for other taxes, indirect taxes such as excise and customs duties, are going to apply to FBT. You will pay the shortfall interest amount if it's to do with something that was outside the scope of your control. You'll pay the general interest charge if the shortfall was functionally caused by yourself or your own errors. Now I'm going to have a brief chat about the different types of fringe benefits. There are lots of them, and they form 12 categories, with the 13th being essentially a catch-all, which is the residual fringe benefits category. And the reason why we have all these different categories is that, first of all, these were the common areas of fringe benefit at about the time that the regime was put in place. But also in regards to the, 12 main categories, there are a series of exceptions in regards to these. And so while we're not going into depth in all of them, we'll look at some of the key areas that it can impact tax professionals. So how do we calculate FBT? It's really just a 3-step process. It's pretty straightforward. It involves first identifying whether or not there actually is a fringe benefit, whether one actually arises in a particular situation. Once you've determined that, you've then got to work out what the taxable value of that particular benefit is, and then we calculate the FDP amount based on that taxable value. So those 3 steps we'll just go through in turn. So what's a fringe benefit? Well, like a lot of these definitions that come up in the indirect tax regimes, it has a very broad definition. So the elements are that there must be something which is a benefit. It must be provided in regards to the tax year, and here it's referring to the fringe benefit tax year. The benefit has to be provided by the employer or at the request of the employer. So it could be by an associate or some sort of third party in regards to a particular benefit, but it has to flow from the employer. And the benefit can be provided either to the employee or to an associate of the employee. And most importantly, though, the benefit has to be related to the employment of the employee. So benefits that are provided sort of ex gratia or as a result of some sort of familial or friendship orientation in regards to an employee and not related to employment won't be fringe benefits and don't fall within the ambit of this system. Thus, while this definition of benefit is very wide, the legislation specifically provides that mere gifts will not satisfy what they call the nexus test. So this nexus test is the relation between the benefit and the employment as part of that. But the type of benefit that it could be is expressed very, very broadly. I think from a strategic perspective, the list of exempt benefits is really something you should get your head around as a student of tax law. The reason for that is that benefits that are exempt from FBT are things that can be provided to an employee. And ultimately, many of these benefits the employee can't get as a tax deduction themselves. So if we think about this, if you've got an employee on the top marginal rate, if you were to pay her or him, say, an additional $10,000 worth of salary, that would be taxed at the top marginal rate. So you would receive in hand slightly more than half that amount. Similarly, if you gave that employee an ordinary fringe benefit, you as the employer would need to pay an amount to make it not really worth your while giving that person $10,000 worth of benefit. So ultimately, including the tax that you would have to pay, the employee would receive in hand a benefit of worth slightly more than $5,000. However, this does not apply where it is an exempt benefit. And having a little scan through this list here, so some examples are healthcare, recreation and facilities, and childcare that is provided to employees in-house. If you were, for example, to give your employee on the top marginal rate in-house childcare facilities, that would be an exempt benefit. So you could spend $10,000 and put that towards the employee, and ultimately that employee is getting the full $10,000 worth of benefit. It's something that they would ordinarily have spent, assuming that they have children in that case, and it's something, because it's a private expense or of a private nature, they wouldn't be able to obtain a tax deduction in regards to it. And so really, when making strategic decisions in business in regards to providing benefits to employees, particularly in the situation where you're trying to recruit high quality employees to meet the particular skill needs of your organization, you really should get a good grip and a really good understanding of what things can be offered that really makes a win-win situation between employee and employer. I mean, ultimately, the only loser here is going to be the ATO, the tax office, because they're not going to be able to tax these exempt benefits. It's also important to note that there are certain types of things that ordinarily would be a benefit to an employee that does flow from the employer that are simply excluded from the FBT regime. And the most obvious of that being salary and wages. Clearly, paying money in the form of salary or wages and cash is not going to be a fringe benefit. It's taxable and it comes under the direct tax regime. Similarly, we have allowances. These are sort of fixed amounts that are paid to an employee that don't go up or down depending on what the employees spent it on, or the amount actually incurred. Other things that aren't fringe benefits are payments to superannuation funds and employee share schemes. Obviously, the benefits that flow from super as well. Also, where you have to pay either lump sum or periodic payments to employees for either restraint of trade or personal injury matters, where they've been done as usually some form of compensation as a result. And finally, dividends and distributions. They're not fringe benefits within the meaning of this regime. Once we've determined that a fringe benefit exists, we've then got to try and work out what the taxable value of that particular benefit is. And there's a couple of things to note. That the taxable value is going to be reduced by a couple of sort of exceptions to the amount that would otherwise be incurred. And the three that we'll talk about here are what's called the otherwise deductible rule, which I'll talk about in more depth shortly. Some specific forms of reductions for specific types of fringe benefits, and I guess most obviously the recipient contribution, and that's the amount that the recipient, the employee, ends up actually contributing towards that particular benefit. We'll talk about each of these in turn. The otherwise deductible rule takes a little bit of time to wrap your head around, and it basically goes like this. If you would give a benefit to an employee and they would otherwise have been able to spend their own money to obtain that particular benefit and obtained a tax deduction, functionally they're being denied that tax deduction because they aren't allowed to deduct something that they've been essentially compensated for. So to avoid a situation here where there's kind of double taxation, the amounts that would be paid to an employee or somehow is compensated an expense that that employee would have incurred that was a tax deduction is not going to be subject to fringe benefit tax. Now, there's sort of as an exception to this, this particular rule actually only applies where the amount that would be deductible is just a one-off. It can't be used for things like depreciation, for example, that's spread out over many periods. Ultimately, though, it's actually an important rule to realize and to understand and appreciate, because in situations where you're paying or basically getting third parties to fulfill the requirements and give benefits to your employees, if those employees could have deducted, then that particular amount is not going to be subject to FBT. In some situations, some fringe benefits will be reduced in terms of the amount that they're going to be taxed on. Now, the specific rules for reducing vary according to the type, and I won't go into those in more depth here. But note that in situation where an employee is receiving one of these, so if they're doing things in regards to work-related medical tests, employment interviews, relocation, temporary accommodation, and benefits provided to employees in remote areas, then those amounts are subject to a reduction of the taxable value as part of it. So it's not that they're exempt, it's just that some fraction of the amount, and that can be 100%, is not included as when you're trying to work out what the taxable value is in order to calculate the amount of tax payable. The fringe benefit tax regime is really supposed to make it neutral for employers providing non-exempt fringe benefits or paying salary for employees on the top marginal rate. The trouble then that flows from this comes from the fact that some forms of acquisitions are going to be able to give the employer input tax credits for GST. As a result, when we're trying to calculate the amount that a particular employer is going to be liable in terms of fringe benefit tax, we have to separate the benefits into those which are subject to GST, and we call those type 1 benefits, and those that are not. So those are ones that the employer cannot claim input tax credits on. We call those type 2 benefits. When we've determined the amount of type 1 benefits and made the calculations in regards to the amount of tax that's liable for that, and then we've done the same for the type 2 benefits, we just add those together. We also need to add into it another category, which is known as the aggregate non-exempt amount. The formula that we use for determining the type 1 and type 2 amounts, they look a little bit daunting, but really they're not. It just takes into account the relevant fringe benefit tax rate, the GST rate, and multiplies these things out. And all you really need to know is the numbers that are there. So where you've calculated the amount of aggregate type 1 fringe benefits, you simply multiply that by 2.0802. That's just what the amount is based on the current FBT rates and GST rates. And for type 2 amounts, it's the aggregate fringe benefit of type 2. So in other words, things that are not subject to GST and no input tax credits can be gained under the GST system. You add those fringe benefits together and multiply that by 1.8868. Now this third element, this aggregate non-exempt amount, that actually only applies for certain types of either public benevolent institutions or health-related charities, non-profit hospitals and such like. With the idea being they still do the same calculations, but they actually get to ignore the first $17,000 in regards to hospital and ambulance services and $30,000 in regards to public benevolent institutions and health promotion charities. For the amount of benefits that go beyond that, and this is to do with each individual employee, if it's more than these amounts, then those amounts are then factored back into the liability of that particular employer. Well, the idea being that you can provide some sort of benefit, but not too much for a particular employee in regards to those kind of specific industries. We'll note at this point that because an employer, when they pay fringe benefit tax, that for most employers, they are going to incur the expense of providing the particular benefit, and they're going to incur the expense of paying the fringe benefit tax in relation to that benefit. So in both cases, in both components, that's a tax deduction. However, that means that tax-exempt employers aren't going to get the benefit of those tax deductions, so they're sort of absolutely worse off. So as a result, there is a specific statutory exception providing a rebate of a fraction of the amount of FBT that's paid for these specific types of employers. Your salary sacrifice. So this is a system whereby an employee and an employer can agree that the employee's wages or salary is reduced by an amount, and that equivalent amount is then given to them in the form of some benefit. Now that particular benefit can either be in the form of superannuation contributions, it can be in the provision of fringe benefits, which can either be exempt or non-exempt as part of that process. So the idea being that an employee, for example, who earns, say, $200,000 per annum, can salary sacrifice $10,000, and the employer provides an equivalent amount of benefit, and then FBT is payable on that. So a couple of things to note. First of all, when you've got a salary sacrifice arrangement in place, that the actual taxable income of the employee is reduced. So the net result is that they're going to pay less income tax. Note also that if the amount reduced is essentially compensated through some form of benefit, then FBT by default is going to apply. So the employer is going to be liable for FBT in regards to that. And in this situation, whether or not the particular benefit is exempt or not really makes a big difference, because particularly for employees on the top marginal rate, a salary sacrifice arrangement is a very viable mechanism in which to reduce your tax obligations. And from the employer's perspective, if the type of benefit that's provided is exempt from FBT, then it's really win-win from both employer and employee in regards to that. Note though that doing a salary sacrifice arrangement with superannuation is going to be a fringe benefit if the superannuation contributions go to a third party. Usually it's not. Usually this is essentially expressed in the form of an additional or optional superannuation contribution. Now, these salary sacrifice arrangements are commonly used for situations where either the employee is going to be able to receive a type of benefit that would be exempt from FBT. So, for example, each year you can get a laptop or some other form of work equipment as part of that. Similarly, the payment of professional membership is the sort of thing that that is exempt from FBT, and the employee could sacrifice salary to go through and do that. Note that you still have to remember the otherwise deductible rule, so that if there is something that the employee would have been able to get a benefit from, that is functionally going to be considered to be exempt from FBT in the employer's hand. Just one other thing to note is that you can't do these things retrospectively. You've got to enter into this salary sacrifice arrangement ahead of time. Okay, now we're going to look at some of the specific types of fringe benefits, because the rules vary slightly between these. And so here we're looking at cars. Cars are pretty common. Most people have them. And as such, if it were easy for an employer to provide a car to an employee in some sort of exempt mode, then everyone would do it. So as a result, these things are quite carefully mapped out. Also note that the rules for car fringe benefits have been simplified in recent years. And basically, a car fringe benefit is one where the employer provides a car in some way. And again, usually this is through a third party. And a car benefit could also be to an associate of the employee as well. But nonetheless, it's a vehicle which is made available to the employee. And see, a couple of things to note here is that in a situation where you've got a ute or a work vehicle or van of some sort, or a taxi, I suppose, and it is by default used for work purposes, and the only private use as part of this is incidental. So that things that are undertaken in the scope of employment that may be private in nature. So, for example, driving the work vehicle to the shops to go and get some food in lunchtime. If the vehicle would otherwise be used in other situations, it's still going to be considered an exempt benefit as a result. The modern rules for determining the taxable value of car fringe benefits, the use of either of two formulas. There's the statutory formula basis, which is the default, and there's also the operating cost basis. We'll go through each of these in turn. The statutory formula basis just starts with the base value of the car. And so that basically is the acquisition price plus the cost of registering it and paying stamp duty and so on. And so the idea is that you take that amount, you multiply it by 0.2. so 20% of that, and then multiply that by the fraction of days that the thing has been provided to the employee or associate of the employee throughout the year. It's pretty straightforward, that calculation, and note that you would, from the taxable value, you would reduce that by any amount that the recipient is co-contributing towards that particular car. With the operating cost basis, you just simply look at how much the particular car costs to run, and so that you would have to follow the statutory rules for deeming the borrowing amounts in terms of interest and the deemed depreciation for that particular vehicle. And note that you would just look at the business use as a percentage to determine how and where the amount of the operating cost is going to be considered to be a fringe benefit when you're going to calculate the tax value. Now, note that in situations where you've leased a vehicle, the operating cost is going to include essentially the cost of the lease as well. Know that in terms of fuel and other things, repairs and services, that's all just folded in together as part of this particular test. Another category of fringe benefit are expense payments. That is where there is a particular expense that the employee or associate of the employee had or is about to incur, and the employer or an associate of the employer instead pays that amount. That is an expense payment fringe benefit. And note that this is quite different and distinct from the payment of an allowance. And the key defining characteristic between the two is that an allowance is paid regardless of the actual expenditure. So, for example, if you pay an allowance for a staff member to have meals, for example, while they're traveling, that amount is a predetermined amount, and you don't actually look at what they actually spend. So the employee could choose to spend that amount, spend more, spend less. That's simply an allowance. And in those situations, they're just straight income, they're like salary or wages. You don't run those things through the fringe benefit regime as a result. Note, though, that where expense payments are made, that first of all it's the GST inclusive value, so it's the whole amount, that's the value, so to speak, to the employee, and the employee can't claim a deduction in regards to those amounts because functionally they've been reimbursed as part of that. You can't double dip in terms of tax deductions. The employer gets the deduction and also the deduction for paying the fringe benefit tax in relation to that expense. One of the less intuitive fringe benefits are car parking fringe benefits. Why is this? Well, most businesses, particularly small businesses, wouldn't have looked at car parking as actually being really much of a benefit to the employee. But it turns out under the system or regime that we have in Australia, basically if you provide a car park for your employees within essentially daylight hours, 7 a.m. till 7 p.m, and if a commercial parking station is located within 1 kilometre, then a car parking fringe benefit is going to arise from that. And so in terms of determining whether or not there is a benefit, you actually look at the fees that commercial car parking vendor would charge for an all-day fee, and then you look at the indexed values which are in the legislation and regulations, and you compare those two things. If the lowest fee that's charged by one of those car parking vendors is more than this threshold, then functionally your employees are receiving some form of benefit from the employer, and the employer is going to be liable to pay fringe benefit tax in regards to those car parks. It's a little unintuitive, but it is, actually a component of our tax law. One final thing to note about fringe benefit tax are some of the exemptions that an employer can have in regards to accommodation and food. By default, accommodation and food are going to be fringe benefits. You have to be paying FBT in regards to those. However, in relatively recent changes, the accommodation and food that's provided to fly in, fly out and drive out employees is going to be exempt from fringe benefit tax. Also note that if an employer contributes towards an employee maintaining an Australian residence in a situation where that employee is required to live overseas, that's also going to be exempt from FBT. Note that in each of those situations, the relevant employees must provide written declaration to the employer in order for them to obtain this exemption from FBT. I'm going to look now at excise and customs duty. And this is a form of indirect taxation, which is to do with goods that are either produced or manufactured or sold inside Australia, or goods that are imported into Australia. And the thing is with excises and customs duties as well, is that the particular type of goods that are created or produced, distributed, matters. And the key areas are fuel, tobacco, and alcohol. Those provide a non-trivial amount of revenue to the federal government. What happened in the 90s in this Hammond and New South Wales case is that the High Court essentially ruled what many said was unintuitively to render the state licensing and excising systems unconstitutional. And they've said that, look, ultimately the Commonwealth was given power to levy excise and customs. If the states are going to go through and do that, then those amounts can't be in the form of an excise. They can have licensing fees and they can have things not regulate, but they can't be more than the actual cost of those particular activities. And so as a result, this created even more of a problem in terms of the vertical fiscal imbalance between the states and the Commonwealth. And so now it's commonly accepted that only the Commonwealth can impose excise and customs duties. Looking at the excise legislation, it has to be noted that excise is to do with goods that are created and distributed in Australia. It's to be contrasted with goods that are imported. And really there's 3 steps to doing this. That you need to be able to impose excise duty, identify what the particular goods are and the relevant rates, and then those particular rates need indexing, in other words increasing, usually every year. And note that again the key areas are the things that form up either items that for policy reasons we don't want to be too cheap and we want to discourage people from using, which is alcohol and tobacco. And we wish to encourage some amount of efficiency in terms of fuel and fuel use. Now, this is still functionally a revenue-raising exercise. And so the fuel excise functionally is designed to help fund other areas of the Commonwealth, whereas alcohol and tobacco are kind of really there to for policy reasons, to try and discourage people from actively going and wrecking their lives by smoking too much and drinking too much. Don't get me wrong, the Commonwealth government is very happy to take billions and billions of dollars from taxpayers in regards to these areas, but functionally, if we could discourage people from smoking tobacco, it would actually create a great amount of relief to the healthcare system. So there is a balance to be noted there. And the last thing to note is that wine, Australia being a very large wine exporter, has a separate and distinct set of rules as well. As anybody who's ever either drunk alcohol or smoked cigarettes, you may be acutely aware that the price of such things goes up twice a year. So tobacco, though, in terms of its price increases, they change twice a year based on the average weekly earning figures. So they're indexed to earnings based on data gathered by the ABS. Whereas alcohol and petroleum products are indexed according to the CPI. That's basically with inflation. So in situations where wages go up or down separately and distinctly and differently from prices going up and down, the price of tobacco will change according to incomes, whereas the prices of alcohol and fuel will go up according to prices. Note that these are statutory indexed mechanisms that will happen automatically. Now, the government can choose to override these particular amounts, and they can do that by passing legislation. However, the Commissioner of Taxation also has the ability to override these things. So if Parliament intends to do something, the Commissioner can actually gazette these changes and make the changes ahead of time, and has statutory power to do such things. The last thing I want to look at are customs. And custom duties are things that are imposed on imported goods. And while some of them do mirror the excise rates, so alcohol, tobacco and fuel, and will have the same rates and have very, very similar process of indexing and such like, there are a variety of other forms of duties that are imposed on other forms of goods. And these duties that are placed on goods that are imported in Australia, these have long-standing, historic and very, very political reasons for being in place. And so this idea of placing duties on particular types of imported products and duties that are imposed on products from particular countries, they very much flow from the underlying political sort of economy that underpins these particular transactions. So note that customs and customs duties are collected by the Customs Department, and that money is then transferred, so to speak, to the through the tax office to the general fund. So the excise is collected from and through the ATO, whereas things that are collected at the border functionally are done so by customs themselves.